Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at FTAI, or FTAI Aviation Ltd. FTAI is an aerospace company. FTAI owns and maintains commercial jet engines with a focus on CFM56 engines. Here's the barchart.com technical opinion rating for FTAI. The bar chart rating is a 100% buy and ranks in the top 1% of all short-term signal directions. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that FTAI is well above the moving average line, so the monthly trend in FTAI is up. Now we're going to look at a daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since November, so the daily trend is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. FTAI is below the upper Keltner channel line, so FTAI is inside the buy zone. Since the trend is up, we want to buy a call. FTAI has 10 option chains to choose from. We're going to use the July 19 option chain. Right now, the July 19 options have 48 days to expiration. Here's the most of the FTAI option chain for July 19. FTAI closed at 84.32 on Friday. That means any calls on the list from 40 to 82.5 are in the money. Let's take a look at the profit potential for purchasing the 85 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 85 call is 430 to 460. We try to enter at the midpoint, so we'll use 445 as the buy price. Our call option calculator shows the profit potential for this call based on FTAI price changes at option expiration from flat to a 12.5% increase in price. We can see that if the FTAI stock price is flat at 84.32 at option expiration, the 85 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 80 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 80 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the FTAI stock price is up 1%, the 80 call will lose 31.2% of its value. We want that to be break even or better, so the 80 call does not meet our requirements. Let's see if the 70 call will work. The bid-ask spread for the 70 call is 12.90 to 17.40. We try to enter at the midpoint, so we'll use 15.15 as the buy price. The 70 call works. If the FTA stock price is up 1%, the 70 call will make a 0.1% or $1 profit. That's better than break even, so the 70 call is the one we'll buy. The call option purchase calculator also shows that if the FTAI stock price increases by 2.5%, the 70 call will make an 8.4% or $128 profit. If the FTAI stock price increases by 5%, the 70 call will make a 22.3% or $339 profit. If the FTAI stock price increases by 7.5%, the 70 call will make a 36.3% or $549 profit. The 10% and 12.5% numbers are also displayed. As you can see, the profits get better and better. And notice that if the FTAI stock price does not make the expected move up and remains flat at expiration, the 70 call would only lose minus 5.5% or minus $83 compared to the minus 100% or minus $445 loss for the 85 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the FTAI July 19 70 strike call and sell to open the FTAI July 19 80 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 70 call for $15.15, sell the 80 call for $7.50. $15.15 minus $7.50 equals $7.65. So the entry price or debit cost for the spread is $765. The call option spread analysis calculator picture shows that the spread will make a 30.7% or $235 profit if the FTAI stock price declines by 5%, remains flat, or increases in price when the options expire. If FTA is down 7.5% at expiration, the trade will make 4.5% or $35. Creating the debit spread will allow us to collect a $750 cash credit to our brokerage account for the sale of the 80 call. As we said in the previous slide, this reduces the cost of entering the spread to $765. Here's a note regarding earnings reports. The next FTAI earnings report is scheduled for July 24. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the FTAI July 19 70 strike call for $15.15. We also reviewed the spread. The spread said to buy to open the FTAI July 19 70 strike call and sell to open the FTAI July 19 80 strike call at a debit of $765. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week. Okay.